All right, we're looking at the Greg Steele case study on portfolio construction. Let's scroll down and read the first question. Question 1, Griffin is most accurate with respect to Statement 1 only, Statement 2 only, or neither statement. Let's start reading. Greg Steele is an investment analyst at Money Experts, a financial advisory firm in the U.S. Steele works as a portfolio manager at Monex and also provides consultancy services to a number of large multinational firms. Titan Enterprises is one such firm that offers reliable and up-to-date communication devices and computer parts to its customers. Wayne Griffin is the firm's chief financial officer and has the responsibility of managing and overseeing the firm's defined benefit pension plan. Griffin hired Steele to help him with this responsibility. During an introductory meeting with Steele, Griffin made the following comments. Looks like these are our two statements in question. Statement 1, our pension assets should primarily be composed of long-duration bonds to proxy the long-term nature of our pension liabilities. This will capture the liabilities' long-term risk. So there's some directional truth here. So we do want to be long duration to kind of proxy the long-term nature of the pension liabilities. However, there are going to be some shorter-term liabilities that we're paying out to retirees now. So by just blanket, we should own all long-duration bonds. That's not really taking into account the kind of varying duration of the liabilities over time. Payouts aren't going to all happen at one point in the future. It's going to go over time, even though we have a long time horizon. So we'll say statement 1 is inaccurate so far. And statement 2, since meeting the pension liabilities as they come due is crucial, investing our pension funds in derivatives will not be appropriate since such investments are too risky. This is also going to be inaccurate. As we know, derivatives themselves are not inherently risky. They're only risky if we're using them to speculate on certain assets or risky assets, but we could use derivatives in order to hedge and make our investments less risky, really. So both these statements are inaccurate. So most accurate, statement 1, nope. Statement 2, nope. C is correct. Neither are accurate. Question 2, what is the most appropriate benchmark for the retired lives portion of TE's pension liability, and is Griffin most likely correct with regard to the impact of future benefits? So we left off after statement 2. During the meeting, Steele inquired about the number of plan participants that were retired and currently receiving benefits. That looks like what we're looking at on the question. Griffin stated that benefit payments to such participants were substantial since the plan provides full one-for-one inflation indexation to protect the participant's standard of living. So inflation index payments, that's important. When Steele inquired about the benefits attributable to future service and wages, Griffin stated that such benefits have very little impact on the pension plan's overall liability in the short term. So I think that's the statement that we're looking at for future benefits. So Griffin stated that such benefits have little impact on the plan's overall liability in the short term. So that sounds correct. We're looking at short term. The future service and wages is going to have little impact on the short-term liability. The short-term liability is going to be driven by those current retirees. So we've got two things here. We want to look at nominal bonds or real return bonds or inflation index bonds. That's the same thing as real return, and whether Griffin is correct or incorrect. So we've already determined that Griffin is incorrect with we've determined that he is correct with regard to that. So we're going to rule out answer C. And then so for this last part, we need to determine whether we want nominal or real return bonds. That key here is inflation indexation. If that's important, which it is to the plan, then we want to take into account real return bonds, not nominal, since real return is going to be the return over inflation. So we'll go with B, real return bonds, and Griffin is correct. Question 3. Is McGill most likely correct with regards to the defined benefit pension plan of Fireworks Corporation? So we left off right here, I believe. So we'll start reading. To discuss the construction of an appropriate portfolio for meeting TE's pension liabilities, Steele approached Michael McGill, an institutional portfolio manager and a close friend. While discussing the defined benefit plan of TE, Steele talked about the DB plan of Fireworks Corporation, an old client of Monex. Steele stated that FWC offers its employees with pension benefits that are not indexed to inflation. In addition, the plan is frozen. When Steele asked McGill how to construct an appropriate portfolio for FWC's DB plan, McGill stated that the value of the benefit payments are not exposed to market risk and are fixed. So that's one of our answers here with respect to value of the benefit payments. So I'm going to highlight that. He also stated that the liability will be best mimicked by a portfolio of nominal bonds since future benefits are zero. That's going to be the other statement here. So we need to basically decide whether these statements are both correct or only one of them is correct. And one of the keys here is the plan is frozen. So they don't need to, there aren't any new obligations accruing, essentially. So that's going to be important for the liability mimicking part. So since we're not indexing to inflation and the plan is frozen, he stated that the liability is best mimicked by a portfolio of nominal bonds since the benefits are zero. That's correct. No inflation adjustment and no future benefits. With respect to the first statement, let's just go look at the answers now. So only with respect to the value of benefit payments, we know that's going to be incorrect. We're either going to have both statements or just the one statement. So with respect to the value of the benefit payments, the value of benefit payments are not exposed to market risk and are fixed. We're not necessarily fixed unless they've locked in the full liability with matching bonds. And there's no market risk, but we're still subject to interest rates changing. If interest rates move up or down, that can still change the value of the benefit payments, the present value of that, because it changes our return that we need and the discount rate. So that could still move around. So we can go ahead and rule out A, that both of them are correct, and just go with C, only liability mimicking. Question 4, the most appropriate benchmark for ERF's PBO, so that's pension benefit obligation, will constitute of nominal bonds and equities, nominal and real rate bonds, nominal bonds, real rate bonds, and equities. McGill manages a pension fund sponsored by Employee Retirement Funds, a government agency responsible for offering a defined benefit pension, a defined benefit plan. The benefit payments made by the plan after retirement are not indexed to inflation. Wages are expected to increase at a rate of 6.5% per annum. ERF assumes wage inflation equal to 2.4% and real wage growth equal to 4.1%. So that's kind of that 6.5 broken into two different things, two different parts here. McGill is determining the investment benchmark for the projected benefit obligation. So basically, do we want to have nominal bonds or nominal bonds and equities, nominal bonds and real bonds, or all three in order to kind of meet these future obligations? So nominal bonds is in all three, so that's a yes. And the main reason for that is because our payments are not indexed to inflation. So we don't need to worry necessarily about the real return from the standpoint of like when we're actually paying people out in retirement. So the real bond returns and the stock equity returns are going to come into account for these wage increases. So these wage increases are pretty substantial. And we have wage inflation of 2.1%, 2.4%, and then real wage growth of 4.1%. So we can kind of break this out into two ways. So we can kind of put our real rate bonds towards covering our wage inflation. However, covering 4.1% above wages is probably going to be pretty steep. So that's where equities are going to kind of need to come into play. So this question's a little tricky because we could just go nominal bonds and equities to kind of meet that return. But I think it makes most sense to kind of include all three for those different components there. So we'll go with C, nominal, real rate bonds, and equities.